Is it a bad idea to trade in either traditional stocks or cryptocurrencies during wars? Short answer, it is not automatically a bad idea, but it is a different game, and many people lose money because they trade as if nothing has changed. Here is a clear, war-aware way to think about stocks versus crypto during wars, without hype and without doom. The core rule, before anything else: wars do not kill markets. Uncertainty does. Markets can rise during wars, but they punish short-term speculation, leverage, emotional trading, and so-called sure-thing narratives. Traditional stocks during wars. When trading stocks is risky, in the early stages of war, the first weeks or months, volatility is extreme. News reversals whipsaw prices. Algorithms dominate market movement. If you need the money soon, forced selling during dips locks in losses. And if you chase defense or oil hype late, by the time it feels obvious, it is often already priced in when stocks can still work. Long-term investing, 5 to 10 years or more. Historically, even Second World War-era markets recovered and grew after initial shocks. Broad, boring exposure tends to hold up better. Index funds, utilities, healthcare, consumer staples, these survive wars better than so-called story stocks. What usually does badly? Small speculative technology companies, luxury goods, highly indebted businesses, and anything dependent on cheap energy or fragile supply chains. Crypto during wars. Crypto is not a safe haven in the way gold once was. Why crypto is dangerous in wartime? It behaves like high-risk technology, not like money. Liquidity dries up quickly. Large holders and exchanges dominate price action, and regulatory threats increase during crises. In most modern conflicts, crypto has fallen with stocks, not against them, and crashed harder during fear spikes. When crypto can make sense, only as a very small allocation, think of it as an asymmetric bet. Only if you already understand cycles deeply, and only as a hedge against long-term currency debasement, not short-term war news. Because trading crypto actively during wars is closer to professional gambling than to investing. The biggest trap, thinking war equals opportunity. Many people lose money because they believe war means defense stocks go up. Oil will definitely rise. Crypto will replace collapsing currencies. Professionals were already positioned before the headlines broke. Retail traders usually arrive after volatility peaks, a safer wartime hierarchy. This is not advice, just a pattern. First, a cash buffer. Liquidity equals power. Second, low debt, essential businesses. Third, broad index exposure. Fourth, a small speculative slice, optional. And last, high-frequency trading. This is the worst choice in war. The psychological risk, the hidden killer. Wars increase doom-scrolling, overtrading, confirmation bias, and sleep-deprived decision-making. This alone destroys more portfolios than oil prices ever will. Bottom line, short-term trading during wars, high risk for most people. Long-term investing, historically survivable. Crypto trading, only for experts and only in small amounts. Cash and patience are often the strongest wartime position. This was an information podcast by Politica UK, 2026 Sarnia Delamare FRSA.